Imagine having your investment gains of $50,000 clawed back by the IRS 3 years after you filed your taxes and thought the matter was closed. This is not a hypothetical scenario, but a real case from 2023 as documented in tax court filings. Unfortunately, this is happening to numerous dividend investors, particularly those within the $200,000 to $500,000 income bracket. What makes this situation even more troubling is that many of these investors believed they were in full compliance with all tax laws at the time of filing. The phenomenon of IRS clawbacks on investment gains has become increasingly common, yet it remains largely misunderstood by the investing public. According to data from the Treasury Inspector General for Tax Administration, TIGTA, the IRS initiated over 890,000 audits in fiscal year 2022, with a significant portion targeting high net worth individuals and those reporting substantial investment income. The average audit adjustment for taxpayers in the $200,000 to $500,000 income range exceeded $18,000, representing a material financial impact that many investors are unprepared for. To understand the complexity of this issue, let's delve into the specifics. The IRS code sections and publications that enable these clawbacks are multifaceted and often overlapping. According to Section 61 of the IRS Code, which defines gross income as all income from whatever source derived, the IRS maintains an extraordinarily broad interpretation of what constitutes taxable income. Section 165, which covers losses, provides the counterbalance by allowing taxpayers to deduct losses, but only under strictly defined circumstances. Additionally, Section 469, which governs passive activity losses, adds another layer of complexity for investors who may be subject to limitation rules they are unaware of. IRS Publication 550, which provides comprehensive guidance on investment income and expenses, runs to over 100 pages and outlines the intricate rules for reporting capital gains and losses. Publication 17, the Standard Individual Income Tax Guide, similarly addresses reporting requirements for dividend income, interest income, and other investment-related items. The complexity is compounded by the fact that these publications are frequently updated, and what was compliant in 2022 may not be fully compliant in 2023 due to regulatory changes or new IRS guidance. There are three primary trigger patterns that can lead to these clawbacks, and understanding each is critical for investors seeking to avoid audit exposure. The first trigger pattern involves the failure to properly report investment income, such as dividends and capital gains. This doesn't necessarily involve intentional fraud. It often stems from simple misunderstandings or oversights. For example, consider the case of Margaret, a retiree who received $15,000 in qualified dividends from her brokerage account. She correctly reported these dividends on her tax return. However, she also owned 500 shares of a mutual fund that paid distributions. Margaret mistakenly classified $3,200 in short-term capital gains distributions as long-term capital gains because the mutual fund had been in her portfolio for over a year. The distribution itself, however, was classified as short-term by the fund. This single misclassification triggered an IRS inquiry 3 years later, requiring Margaret to file an amended return and pay back taxes, penalties, and interest totaling $4,800. The second trigger pattern involves inconsistencies in tax filings. If an investor reports a lower income on their tax return than what is reflected in their investment statements or Form 1099 provided by brokers, the IRS's matching systems will flag this discrepancy. According to a comprehensive study by the Tax Policy Center at the Brookings Institution, in 2021, approximately 15% of taxpayers with incomes between $200,000 and $500,000 had significant reporting discrepancies identified during IRS matching procedures. Even more concerning, the IRS has implemented advanced data analytics that can identify patterns across multiple years of filings. For instance, if an investor consistently reports dividend income 5-10% below the amounts shown on their 1099 forms across 3 consecutive years, the IRS algorithm will flag this as a high-risk return for detailed examination. Consider the case of David, a dividend investor who received $45,000 in dividend income reported on his 1099 forms. However, David had structured his dividends to be reinvested through his brokerage automatic dividend reinvestment plan, DRIP. He mistakenly believed that reinvested dividends didn't need to be reported as income, so he reported only $35,000 in dividend income on his tax return. The remaining $10,000 in reinvested dividends were never reported. When the IRS conducted a matching review 3 years later, it identified the discrepancy. David was required to file amended returns for all 3 years, pay approximately $3,500 in back taxes plus penalties and interest. The third trigger pattern involves the improper use of tax deductions and credits. Investors may inadvertently claim deductions or credits they are not eligible for, or they may miscalculate the amount they can claim. This is particularly common with investment expenses. The IRS allows investors to deduct certain investment expenses, such as fees for investment advisory services. These are subject to the 2% of adjusted gross income (AGI) limitation under Section 67. Additionally, the Tax Cuts and Jobs Act of 2017 suspended the deduction for miscellaneous itemized deductions that are subject to this 2% AGI limitation through 2025. Many investors remain unaware of this suspension and continue to claim these deductions. For example, if an investor has an AGI of $300,000 and claims $8,000 in investment advisor fees, they would normally be able to deduct only amounts exceeding $6,000, 2% of $300,000. However, due to the suspension, they may not be able to deduct any of these fees during 2023-2024. To further illustrate these points, let's examine a detailed case study. In 2021, an investor we'll call John, age 58, sold a significant portion of his stock portfolio following his company's merger announcement. He realized total capital gains of $75,000 from the sale. However, John had purchased the shares over a 15-year period at various prices. When calculating his basis for some shares, he used an incorrect average cost method rather than the specific identification method his brokerage recommended. This error resulted in John underreporting his capital gains by $12,000. Additionally, John had realized $8,000 in losses from other stock sales, but he only reported $3,000 of these losses because he was unaware of the $3,000 annual loss limitation rule and thought he could carry forward excess losses. When the IRS audited his 2021 return in 2024, it identified both the understated gains and the improper loss treatment. The IRS reassessed John's tax liability, and he was required to pay an additional $22,000 in taxes, plus penalties of approximately $400 and interest of $1,800 for a total of $28,200. Expert analysis provides valuable insights into this issue. Dr. Janet Holtzblatt, Principal Research Associate at the Urban Institute and expert on tax compliance, notes that the complexity of the tax code, combined with the IRS's increasing use of data analytics and document matching, has created an environment where even well-intentioned taxpayers face significant audit risk. Furthermore, data from the IRS Criminal Investigation Division shows that civil fraud penalties have increased by 34% over the past 5 years, indicating the agency's heightened focus on accuracy in income reporting. It's essential to consider counterarguments and common misconceptions. Some may argue that the IRS is overstepping its authority by reassessing tax liabilities years after the initial filing. However, the IRS has clear statutory authority to do so. Under Section 6500, of the Internal Revenue Code, the IRS generally has 3 years from the date of filing to assess additional taxes. This period extends to 6 years if the taxpayer substantially underreports income, generally defined as understating gross income by more than 25%. For fraud or failure to file, there is no statute of limitations. Others may contend that the complexity of the tax code is entirely to blame for these clawbacks. While the tax code is indeed intricate, this does not absolve taxpayers of their responsibility to comply. As noted by Mark Lusku, Principal Federal Tax Analyst at CCH, a Wolters Kluwer business, investors have a responsibility to either educate themselves thoroughly about tax rules or to engage qualified tax professionals. The IRS will not excuse non-compliance simply because the rules are complex. To mitigate the risk of a clawback, investors should implement several concrete strategies. First, maintain meticulous documentation of all investment transactions. This includes brokerage statements, confirmation statements, dividend notices, and records of any basis adjustments. Second, investors should accurately report all investment income on their tax returns, cross-referencing their returns with all Forms 1099 DIV and 1099B provided by their brokers. Third, investors should consult with qualified tax professionals when claiming deductions and credits, particularly those related to investments. Tax professionals can help ensure that deductions are properly calculated and fall within applicable limitations. Additionally, investors should understand the IRS's specific authority to audit and adjust returns. The IRS maintains sophisticated data analytics systems that cross-reference tax returns with Forms 1099, Forms 8949, sales of capital assets, and Schedule D, capital gains and losses. Any significant discrepancies will trigger automated flags. Investors should also be aware of the expanded statute of limitations that applies when income is substantially underreported. In conclusion, IRS clawbacks of investment gains represent a significant and growing risk for dividend investors in the $200,000 to $500,000 income bracket. The agency's sophisticated matching systems, combined with the complexity of tax rules governing investment income, create substantial audit exposure. By understanding the specific IRS code sections that enable these clawbacks, sections 61, 165, 469, and 6501, recognizing the three primary trigger patterns, maintaining detailed documentation, and seeking professional guidance, investors can substantially reduce their risk. As the tax environment continues to evolve and the IRS deploys increasingly advanced analytical tools, it's essential for investors to remain vigilant and proactive in managing their tax obligations. The cost of non-compliance, in terms of